Have you ever considered the financial risks of not knowing about put options? In the world of investing, ignorance isn't just bliss, it's costly. Put options are not just a tool, they are an essential component of a savvy investor's toolkit. Imagine a scenario where the market takes a sudden dive. Those in the know, with an understanding of put options, have a safety net, allowing them to mitigate losses or even profit from market downturns. On the flip side, the uninformed could watch their portfolios diminish, missing out on crucial opportunities to safeguard their investments. Put options grant the holder the right, though not the obligation, to sell a specific amount of an underlying asset at a predetermined price before a set expiration date. This can be a game changer in volatile markets. Without this knowledge, investors are like sailors navigating stormy seas without a compass. Understanding put options could be your key to smarter investment decisions. So, what exactly are put options? Imagine you're holding a golden ticket, but instead of visiting a chocolate factory, this ticket gives you the power to sell a stock at a predetermined price, no matter how the market tumbles. This golden ticket, in the world of finance, is known as a put option. A put option is a type of financial contract that gives the holder, the buyer of the option, the right, but not the obligation, to sell a specified amount of an underlying asset like a stock, at a set price known as the strike price before the option expires on a certain date, aptly named the expiry date. Let's break this down a bit. The strike price is essentially the target sale price agreed upon by the buyer and the seller of the put option. It's like setting a safety net where you can sell your stocks if they start to plunge beneath this price. Think of it as locking in the minimum sale price for your shares. The expiry date is just as crucial. It's the deadline by which you must decide to exercise your put option. After this date, the option either becomes worthless or is executed, depending on the stock's market price relative to the strike price. Now, acquiring this option isn't free. The buyer pays a price called the premium. The premium is the cost of having the choice, or the luxury, if you will, to sell your asset at the strike price. It's like paying for an insurance policy. You hope you never need to use it, but it's there, offering protection when a storm hits the market. In essence, put options are tools used by investors to hedge against potential losses in their stock holdings. They provide a safety buffer, allowing investors to manage risk in a highly volatile environment. This strategic capability to limit loss while maintaining the potential for profit makes put options a valuable component of modern financial portfolios. Armed with this knowledge, you can start to see how put options function as a form of insurance against stock price declines. Now let's delve into how put options actually work. Imagine you're eyeing a stock from a company called Tech Giant, currently trading at $100 per share. You suspect the stock might drop in the next few months. To capitalize on this, or to protect your existing shares from losing value, you consider buying a put option. A put option gives you the right, but not the obligation, to sell a stock at a predetermined price, known as the strike price, before the option expires. Let's say you buy a put option with a strike price of $90 that expires in 3 months. For this option, you pay a premium, which is the price of the option, say $5 per share. Fast forward 2 months, and your hunch proves correct. Tech Giant's stock falls to $70. Since you hold a put option, you can now sell the stock at $90, despite its current lower market price. By exercising your option, you sell at $90 and could potentially buy back at $70, netting a profit per share, minus the premium you paid. However, market conditions play a crucial role. If Tech Giant had released a groundbreaking new product, and its stock had risen to $120 instead, your put option might not be exercised because selling at $90 would not be profitable. In this scenario, the most you'd lose is the premium paid, which is the $5 per share. This illustrates a key aspect of put options. They can serve as insurance. By paying the premium, you're essentially insuring against a significant drop in the stock's price. This is particularly appealing in volatile markets where stock prices can fluctuate dramatically. Remember, choosing the right strike price and expiry date requires a good understanding of market trends and the specific stock. Each decision influences the cost of the option and its potential payoff. With the right strategy, put options can provide significant protective benefits and profit opportunities. Why should you consider using put options in your investment portfolio? Well, there's more to put options than meets the eye. They're not just about betting on stocks going down. They can be a strategic tool for managing risk and enhancing returns. Firstly, put options are often used for hedging. Imagine you own shares of a company, but you're worried about potential short-term losses, perhaps due to an upcoming earnings report or some economic turbulence. By buying a put option, you get the right to sell your shares at a predetermined price, regardless of how low the market price drops. This acts like an insurance policy, protecting your investment against significant declines. Moreover, hedging isn't just for individual stocks. Portfolio managers routinely use put options to protect entire portfolios. This strategy is especially popular during times of market uncertainty. When executed well, it allows investors to maintain their market positions, knowing they've capped their potential losses. Now, let's talk about speculation. Put options can be used to speculate on the decline of a stock price. If you believe a stock is overvalued and poised for a drop, purchasing a put option allows you to profit from this potential decline. This is because the value of your put option increases as the stock price falls below the strike price. It's a strategy that requires good timing and a strong understanding of market dynamics, but it can be quite profitable. Another strategic use of put options is to generate income. By writing put options, an investor agrees to buy a stock at a certain price within a specified time frame. In return, they receive a premium from the buyer of the put option. If the stock stays above the strike price, the option expires worthless, and the writer keeps the premium, effectively earning income. This strategy, known as selling puts, can be particularly appealing in a stable or rising market. However, it's crucial to manage risks effectively when dealing with put options. Understanding the potential outcomes and preparing for possible market movements is essential. Overlooking this can lead to significant losses, especially with strategies like writing puts, where potential losses can exceed the premiums received. Properly used, put options enhance your financial toolkit, providing flexibility and safety. Let's quickly recap what we've covered about put options. Put options are financial contracts that give the holder the right, but not the obligation, to sell a specific amount of an underlying asset at a predetermined price before a specified date. They function as a form of insurance against declining stock prices, offering investors a way to hedge against potential losses. The working mechanism of put options involves three main components: the strike price, the expiration date, and the premium. The strike price is the price at which the option can be exercised. The expiration date is when the option expires, and the premium is the cost of purchasing the option. Strategically, put options can be used in various ways. They can protect individual stock holdings or entire portfolios from downside risk. Additionally, savvy investors might use them to speculate on the anticipated decline in the price of stocks, thereby potentially earning profits from downward movements. Remember, a well-informed investor is a powerful one. Don't overlook the protective power and potential of put options.